I am Professor Jessica Wachter, and I am your instructor for this course. We're going to cover the net present value rule, present value decisions, valuation of bonds and stocks, and finally, the internal rate of return. The goal is to understand how best to make capital budgeting decisions. Another term for these decisions are investment decisions. These are the decisions about what projects to undertake and whether they increase or decrease value. The goal here is to increase economic value, keeping in mind that while decreasing value is not illegal, it is very undesirable. So we want to increase value. Amazingly, there are general principles that can teach us how to make value-increasing decisions. It's not surprising that the development of these general principles was responsible for many Nobel Prizes. I think they represent some of the finest scientific achievements of the last 50 years. In this section, we are going to discuss the net present value rule. So imagine you are running a corporation. How are you going to decide which projects are worth investing in? That's what the net present value rule is designed to do. What this section will discuss is why the net present value rule should be the criterion for choosing which projects a corporation should undertake. So I'm not asking you to take on faith that we should use the net present value rule. Hopefully, by the end of this section, you will be convinced that the net present value rule is the rule that increases the value of the corporation. And I will discuss how to compute net present value. Okay, so first we're going to talk about future value. So we deposit $100 in a bank account that pays 10% interest. The future value then is my deposit plus what I get in interest, in this case, 10% on $100. Well, what's that equal to? That's equal to $110. In general, for some interest rate R, the future value is going to be 100 times 1 plus R. With future value, note that we're moving the cash flow forward in time. That's future value. What about present value? Suppose you need $100 in 1 year. What do you put aside today? So now $100 is the present value, is the future value, and you're looking for present value. So you're looking to solve 100 equals present value times 1 plus R. You're putting aside present value today, and by the previous formula, it grows up at 1 plus R to become $100. Well, let's just solve this equation. Present value is $100 over 1 plus R. So if R, for example, is 10%, my present value is $90.91, more or less. Note that we're bringing the $100 backward in time. So what's our general formula for present value? So in general, if we have a cash flow C in 1 year, what's my present value? It's simply C over 1 plus R. Now, one thing to note is this is sometimes called the present discounted value. Why is that? Well, if R is greater than 0, then note the present value of C is going to be less than C. That makes sense. So we call this present discounted value because normally we think of R being greater than 0. Well, recently, R hasn't always been greater than 0. Sometimes we see it actually equal to 0. Well, no big deal. Present value of C is less than or equal to C. So, just as an aside, why do we think that R should be greater than or equal to 0? So suppose the bank offers R of minus 8%. So let's say if we deposit $100, next year we'd get $92. I think most of us, most of the time, would say, no thanks, we'll just keep the money in the cookie jar. This example is why we believe that R greater than or equal to 0 is a safe assumption, whereas R negative can't happen. Let's just remember, though, that the reason why we're assuming R is greater than or equal to 0 is because we can put that money in the cookie jar. We're not afraid, say, of somebody taking the money, of something happening to the money. So this may not hold at all times in all places. There might be certain times where we might not see R greater than or equal to 0, where storing money might become very expensive. So one thing to remember about the 2008 financial crisis is briefly R was equal to 0 and then possibly less than 0. Other things that happened around that time is that the price of safes and sale of safes spiked, and so did the sale of guns. So sometimes storing money can become expensive. And so R greater than or equal to 0 might not hold all of the time. But most of the time it holds, and that's an assumption that we're going to use. So that was present value. Let's talk about net present value. Net present value is equal to C0 plus C1 over 1 plus R. This C0, that's the negative of the cost of the investment. This C1, that's the payoff in 1 year. So most of the time, C0 is going to be a negative number, and C1 is going to be a positive number. So you can see from this example that net present value is really just present value, right? The net just emphasizes that we've included a first term. That's the initial investment. So let's do an example of net present value. So let's say we're a software developer, and there's a cost or a required investment of $0.5 million to develop the software. And then next year, what are we going to get? The payoff is going to be $0.54 million. Okay, so my NPV in millions is minus 0.5. That cost is an outflow. That C0 is negative. Plus, we take that 0.54 and discount it back to the present, just as we discussed with present value. So by the way, if we put in R of 5%, my NPV is $0.0143 million. So that's net present value. So in this video, I'm going to discuss something very profound, which is the net present value rule. The NPV rule. It says, accept projects if NPV is greater than 0. Reject projects if NPV is less than 0. And here's the big result. The NPV rule maximizes the value of the corporation. Something so simple and yet so profound. Why is this? We're going to do a very simple example that consists of a corporation that's just one person. This person we're going to call Susie. And Susie has access to a bank account with which she can use to transfer consumption between now and old age. And she also has some access to opportunities. So let's just say Susie, she has $1 million. She has access to a bank account with R equals 20%. Now, this 20% may seem crazy high, but the point is that 20% is how she's going to transfer money between now and her old age. So right away, without any investment opportunities, she has a choice. She can consume $1 million now, or $1.2 million in old age, or something now and something in old age. So we can show Susie's possibilities on a graph. This is dollars today. This is dollars in old age. So for every dollar that Susie doesn't spend now, she gets that dollar times 1 plus R in old age. So the slope equals 1 plus R, or 1.2. So let's say she's considering opening a restaurant. The cost of the restaurant is 0.7. So if she spends 0.7 on the restaurant, she'd have 0.3 to consume now. The payoff on the restaurant is 0.8. Should she open the restaurant? Well, we don't have to think too hard to say that the answer is no, because she could also decide to consume 0.3 now and save the 0.7 in the bank, in which case it becomes 0.84 if deposited in the bank. So on this graph, the restaurant is here. Not a wise investment. Let's think about another example. Okay. Suppose she sees a vineyard. That's going to also cost 0.7. However, the payoff in her old age is going to be 0.91. Well, 0.91, that's greater than 0.84. The vineyard is somewhere over here. This question is, should she invest in this vineyard? Seems like a good idea. She could get more money that way. But let's think for a second. Is it so obvious? After all, what if this Susie really likes to spend money now? Maybe she has a good reason for wanting to spend the money now. Maybe she wants to spend more than 0.3, for example. Maybe then she shouldn't do the vineyard. Maybe she should spend the money instead. For instance, maybe she wants to get an MBA. Who knows? Maybe she wants to help out a relative who doesn't have any money. There might be very good reasons to spend this money now and not on the vineyard. Well, so what the NPV rule says is that no matter what her preferences are for consumption now versus consumption in the future, in this case, she should go for the vineyard and she should not go for the restaurant. Why is that? Well, if she wants to spend more, she could borrow the money for the vineyard. Let's see this on the graph. This is dollars now. This is dollars in old age. This is my bank account. And this is the new opportunity set with the vineyard. Why? Well, first of all, we could always be here and consume 0.3 now and spend 0.7 in the vineyard, which will give us, as we talked about, 0.91. But in fact, with the help of the bank, we can be anywhere on this new line, which, by the way, still has the same slope of 1 plus r. How does that work? Well, let's take as an example this extreme point right here at the bottom. Susie wants to consume everything today. So if she wants to consume everything today, what is this point? Well, remember, she has 0.3 that she didn't have to spend on the vineyard. Then she takes the 0.7 and invests it in the vineyard. That becomes 0.91 in the future. Now she knows she's going to get 0.91 in the future. And for the sake of the example, the bank knows it too. So she can borrow against that 0.91 and consume the present value of that 0.91 today. So whereas this point here is 1 million, with the vineyard, and keep in mind R here is 20%, with the vineyard, she has the opportunity to consume more, 1.06 million. This point here is 1.06. So regardless of Susie's preferences for present versus future consumption, she should always choose the project with that is NPV positive. So where does NPV come into all of this? Because I haven't said anything about NPV. Remember, NPV rule says, except if the NPV is greater than 0. What's my NPV? NPV is C0 plus C1 over 1 plus R. So what I want to know is this thing greater than 0? That's the same as asking, is C1 bigger than minus C0 times 1 plus R? So let's think about the restaurant. So the restaurant gave us 0.8. So the question is this bigger than 0.7? 0.7 is the negative of the cost times 1 plus R. Well, 0.7 times 1.2 is 0.84. So no, the restaurant had NPV less than 0. So we should reject it. But the vineyard, in that case, 0.91 was bigger than 0.7 times 1 plus R. NPV was bigger than 0, so we should accept it. And remember, the fact that we should accept this, it doesn't matter if Susie wanted to consume the money now versus later, because she could always use the bank. So this brings us to a very important consequence of the NPV rule. It's something called the Separation Theorem. So what the Separation Theorem says is that we can separate two decisions. First decision is when to consume, and the second decision is what projects to choose. this second decision is going to be made according to the NPV rule. The first decision is, well, that's just personal preference. This separation theorem is very powerful. Imagine if it were not true. Suppose that we couldn't separate when to consume and what projects to choose. What that would mean is if we had a corporation, the CFO of the corporation would have to find out the consumption preferences of all the investors. That would be very annoying. Not only would it be annoying, how would you even trade such a corporation? You would want to know what the other investors are. What did they want? What did they like? Currently, we don't care about that. We can trade stocks without worrying who else is holding the stocks. It's not an exaggeration to say that this separation theorem is the basis for our secondary markets in stocks. If we didn't have this, we wouldn't have secondary markets. And if we didn't have secondary markets, we wouldn't be able to diversify. And if we couldn't diversify, we couldn't invest. And we probably wouldn't have any economic growth, or not nearly so much. So this separation theorem is pretty important. In the previous section, I discussed the net present value rule. In that section, the examples were simple. There was a cost for the project and a payoff at some future time. But usually, examples are a little bit more complicated. There are payoffs spanning multiple years, so we need a way to deal with that. Also, these payoffs may go on for an indefinite length of time. That happens, for instance, if you're valuing a stock. So that's where the perpetuity formulas come in. In this section, I will cover compound versus simple interest, the annuity and perpetuity formulas, and finally, compounding within a year. These topics are important not just for valuing bonds and stocks in the next sections, but also for Finance 612 and for all finance electives. Suppose we have $100. What can we count on getting if we invest this in a bank at an interest rate R for 2 years? Let's say R is 7%, and we're investing for 2 years. Well, under something called simple interest, my future value, so what I'd have at the end of 2 years, would be my principal plus my first interest payment of $7 plus my second interest payment, $7, or $114. So we get the interest twice. But there's something a little funny here. So the second interest payment, we're getting interest on the $100. Well, why not earn interest on the $7? That leads us naturally to compound interest. Under compound interest, we earn interest on interest. So we get the $100, that's our principal. Then we get $7. Then we get another $7. And finally, we get the interest payment on the first $7. Another 49 cents. Let's just do it with the letter R. We get $100. Then we get our interest payment. Then our second interest payment. And then interest on interest. If you do the algebra, This is $100 times 1 plus R. Okay, that's what we get after 1 year. Then, after the second year, we get that same amount reinvested. That's 100 times 1 plus R times 1 plus R again, or 100 times 1 plus R squared. Okay, so if we have compound interest, T years, then the future value is $100 times 1 plus R to the power T. Well, we've just seen this can make a difference. So for T equals 2, and let's stick with the R equals 7%. For T equals 2, with simple interest, that gave us $114. Compound interest gave us $114.49. Well, who cares if it's just 49 cents? Suppose we weren't just investing for 2 years. Suppose we were investing for 100 years. Well, in that case, under simple interest, we would get our $100 and we'd get 100 interest payments. Each of them would be $7 for a total of $800. Not too bad. But what if we had compound interest? We would earn interest on interest for 100 years. That's 100 times 1.07 to the 100th power. That's not $800. That's $86,000.771. So it's a big difference. This is the power of compounding. So what's the correct formula to use? Do we use the simple interest formula or the compound interest formula? Do we get the 800 or the 86,771? Well, it all depends if we can reinvest the proceeds or not. Unless stated otherwise, I will be assuming that the proceeds can be reinvested. Okay, so that's future value. What about present value? So for present value, we ask, what do we need to set aside today to have $100 in T years? So present value solves the equation. Present value times 1 plus R to the T equals 100. So we can see that the present value, the amount that we set aside today, is 100 divided by 1 plus R to the T. So this 1 over 1 plus R to the T has a name. It is sometimes called the discount factor. Sometimes people just call it DF. So that's the simplest present value calculation you can do. You have one cash flow, T years in the future, and then you discount it back to the present. The next most complicated cash flow is something called an annuity. An annuity has equal payments and there's lots of annuities around, right? Like a mortgage has as part of it an annuity. Most debt has as part of it an annuity. And then, of course, there are actual annuities. So let's just do a quick example. How much would you pay for $100 a year for 3 years. Well, this is the same as how much you would pay for $100 in 1 year, plus $100 in 2 years, plus $100 in 3 years. And that's all there is to it. If we want to get fancy, we can think about a formula for an annuity that lasts for T years. The present value is C over 1 plus R plus C over 1 plus R squared. C is the cash flow, plus, now we have an ellipsis because we have an arbitrary number of terms going out to some amount T. Now, we could clearly plug this into a spreadsheet for any C and any R and get a number. Well, we can also use the reasoning of geometric series, and there's details in the notes if you're interested, to derive a formula for this. What it is C over R times 1 minus 1 over 1 plus R to the T. Sometimes it's useful to define something called an annuity factor. An annuity factor is simply 1 over R times 1 minus 1 over 1 plus R to the T. An annuity factor takes any cash flow, C, and tells you how much would you be willing to pay to get C every year for T years. So, by the way, in the example that we did, so let's say R is equal to 5% and T is equal to 3. We're going to calculate the present value of $100. So the present value is 100 over 0.05 times 1 minus 1 over 1.05 cubed. And that is equal to $272.32. So let's do one more example with an annuity. Let's say you take out a 15-year mortgage. So we have a 15-year mortgage. The loan amount is $0.5 million. The interest rate is 4%. Now, here's the thing. In this case, the owner of the asset is the bank. The cash flows on the assets, the C, that's your payments to the bank. So in solving this problem, what we are doing is we are setting C so that the value to the bank is correct. So the present value is the loan amount. The present value has to equal C times the annuity factor for 15 years at 0.04. Well, we can separately calculate what this annuity factor is. It's 11.12. So that tells us that C must be 0.5 million divided by 11.12, or $45,000 per year. Now, suppose we wanted to calculate the future value of an annuity. That's not hard to do. Suppose we want to calculate the future value of anything. Suppose we want to calculate the future value of blob. Well, what we do is we take blob and we multiply blob by 1 plus R to the T. So to calculate the future value of an annuity, all that is my present value times 1 plus R to the T. So notice this present value, That's what I've substituted in for blob. So something very interesting happens to an annuity when t goes to infinity. So remember the formula for the annuity. The formula looks like this. Remember what lies behind the formula? Well, we take the first cash flow and discount it back 1 year, the second cash flow and discount it back 2 years, and then ... we go out to the last cash flow and discount it back t years. Okay. So that's what happens for our annuity formulas. So now we're interested in the limit as t goes to infinity. So let's think about this first equation. If r is bigger than 0, what does that tell us? That tells us that 1 over 1 plus r is less than 1. We're actually discounting this. So as t goes to infinity, that implies 1 over 1 plus r, so the t approaches 0. And we get, as a result, one of the most beautiful formulas in all of finance. The present value of a consul. A consul is the limit of an annuity as t goes to infinity. Present value is simply c over r. Note what we assumed. For this formula, we really need r to be bigger than 0. For the annuity formula, you don't need r to be bigger than 0. It may look like you do, but you actually don't. You can play around with it. But for this, you need r to be bigger than 0. Why is that? Let's remember what lies behind the formula. We're taking c discounted back 1 year, c discounted back 2 years, c discounted back 3 years. Well, I could just keep going forever and ever. But the key point is, as long as r is bigger than 0, these terms are getting smaller and smaller. If r were equal to 0, they wouldn't be, and we'd get to infinity. Or if r was less than 0, they'd be getting bigger and bigger, and it would be even worse. So we do need r to be bigger than 0 to define a consul. Let's do some examples of a consul. Suppose that r is 10% and c is $100. The question is, how much money would you be willing to pay to get $100 every year forever if the interest rate were 10%? Well, $100 every year forever at an interest rate of 10%, that's a consul. So we use the formula, it's c over r. In this case, it's 100 over 0.1 or $1,000. What if the interest rate doubled to 20%? Well, in this case, the present value would be 100 over 0.2 or $500. So if the interest rate is 20%, $100 per year forever, that's only worth $500. 2 points to make about the consul. First of all, notice the interest rate doubles, the price halves. This is a general point about present value formulas. The higher is the interest rate, the lower is the present value. And that's simply because the higher is the interest rate, the more you could earn in the bank, the greater is the time value of the money. And so the less you need to put aside today to have a certain amount of money in the future. So this is a very simple example, but we can think about some of its real-world consequences. For example, if the Federal Reserve announces that interest rates are going to be higher, or at least that its target interest rate is higher, sometimes we observe stock market declines. That shouldn't be mysterious. If we have higher interest rates, that just means that the time value of money is higher, and so future cash flows are worth less. My next point is, how relevant is this console formula anyway? Do we ever see console bonds? Well, it might interest you that close to home we saw something close to a console bond. So you might be interested to know that the University of Pennsylvania issued debt, and the maturity of that debt was 100 years. That's longer than the U.S. government. So the University of Pennsylvania, who knows what's going to happen to the U.S. government, but 100 years from now, we're still going to have a University of Pennsylvania. Now that's 100 years, not infinity. That's not a literal console. But there are, in fact, literal consoles. So the United Kingdom issued a console bond as a war bond, just like the United States issued war bonds to pay for World War I. So the United Kingdom issued console bonds to pay for a war. In this case, the Napoleonic Wars. And in fact, those console bonds were still paying their coupons up until very recently, until the government decided to buy them back because it just wasn't worth the bother anymore. So these consoles really do exist. As an approximation to the console, we can think about preferred stock on a company. Those cash flows tend to be known for sure, as opposed to, say, common stocks, and we can think of them as going on for a long time. So one of the most useful things to know how to value is something called a growing perpetuity. So for a growing perpetuity, we have a payment that grows at a fixed rate forever. So how does this work? Now, when anything gets a little bit complicated, it's very useful to write down a timeline. So for our growing perpetuity, we won't have anything at time 0. At time 1, we will have our cash flow C. At time 2, we'll have our cash flow, but now we're going to grow it up by G. G stands for growth. At time 3, we're going to take our G and grow it up again. And then ... we're going to continue this forever. So when we calculate the present value, we have our first payment, our second payment, which we discount back, our third payment, which we discount back, and on and on. So we have a very beautiful formula for this. Let's just write out what we had to begin with. C discounted back 1 year. C times 1 plus G discounted back 2 years. And on and on. A typical term in the future is going to have C times 1 plus G to the T minus 1 discounted back T years, and on and on. Now, as you could tell from our previous discussion, what's really going to matter here is whether these terms are decreasing exponentially or are they growing exponentially. For them to be decreasing exponentially, we need the condition R bigger than G. So if R is greater than G, then that formula reduces to C divided by R minus G, the growing perpetuity formula. If R is less than G, or if R is equal to G, then the formula does not exist. So notice a couple things. When G equals 0, the present value is C over R. That's good. That's the formula we got from before. Notice also that the larger is R, the lower is the present value. That makes sense because the higher is R, the greater is the time value of money, the less you need to put aside today. Notice also that the greater is G, the greater the growth rate, the greater is the present value because G appears in the denominator with a negative sign. And that makes sense too because the bigger are these G's, the bigger are these terms, and the bigger is the thing that you're discounting back. So that's a growing perpetuity. Another important type of cash flow to value is a delayed perpetuity. And this can be surprisingly tricky. So a delayed perpetuity says we have C, cash flow C, every year starting 3 years from now. A cash flow C every year starting 3 years from now. Let's write down that cash flow diagram. So here we are at time 0. We don't get anything. At time 1, we don't get anything. At time 2, we don't get anything. At time 3, we get our cash flow. At time 4, we get our cash flow, and on and on. What's the value of this asset? Well, let's just remember for a moment, what is the value of our usual perpetuity? What do the cash flows look like? So if we don't delay the perpetuity, the first cash flow starts at time 1. So this guy has a present value of C over R. Now let's go to our delayed perpetuity. Zero, 0. 3 years, the cash flow starts, and then it continues in perpetuity, forever. So what you want to do is put yourself at time 2. Because remember, for the perpetuity, the first cash flow starts 1 year from now. That's our convention to get that nice formula C over R. You could have a different convention, then you'd have a different formula. That's our convention. So at time 2, the present value of this perpetuity is C over R. At time 2, it's just an ordinary run-of-the-mill perpetuity. So now, to get it back to time 0, what do? We discount it. The present value is this present value discounted back to time 0. How do we do that? We divide it by 1 plus R squared. So it's very counterintuitive. A perpetuity whose cash flows begin in 3 years is the perpetuity formula discounted back 2 years. In general, if we have a perpetuity, cash flows begin in T years, the present value is 1 over 1 plus R to the T minus 1 times C over R. A little strange. All we have to do is remember, when we have an ordinary perpetuity, the cash flows are 1 year from now. So we've made an important simplifying assumption, and that is that compounding occurs once a year. Suppose that interest is paid and reinvested more frequently. Let's say 2 times a year. example. So a bank offers a stated annual interest rate of 8%, compounded semi-annually. If we invest $100, what do we have after 1 year? So what does this mean? So if we have a stated annual interest rate of something, R, what happens is that we take that R and we adjust it to create a period rate. So in this case, if we have a stated annual interest rate of 8%, compounded semi-annually, my future value of $100 is going to be 100 times 1.04 squared. So this 0.04, that's what I call my period rate. And this 2, that corresponds to my frequency. And we're going to use the terminology stated annual interest rate. We'll be consistent about that. So in consumer credit, sometimes this is called the APR, the annual percentage rate. Okay, so what's the general formula? The general formula is that the future value is equal to, well, let's just say it's $100 that we start with, times 1 plus, so our period rate is the stated annual interest rate divided by our compounding frequency M. And then we compound this M times. That's our future value. We can also have our present value. So what's the present value of $100? The present value is $100. And now we're going to divide by this. Well, that would be kind of a mess to put this in the denominator, so we'll just use minus M. And if we want to have this going on for T years, we just stick a T over here. This is 4 T years. So let's do some examples. Remember, future value is 100 times 1 plus stated annual interest rate divided by M to the mth power. In our example, we'll take the stated annual interest rate to be 8% per year. Well, if M equals 1, we're back to annual compounding. So our future value is just simply 108. You can see how that works in this formula. When N equals 2, now we're doing semi-annual compounding. The future value is equal to 100 times 1.04 squared, which is $108.16. Well, there's other possibilities. You could do quarterly, for example, but let's skip ahead to monthly. So for monthly, we get 100 times 1 plus 0.08 over 12 to the 12th power. Well, that's $108.30. Well, if we want, we can compound every single day, including holidays. 365 days a year. So this M is a frequency per year, so that's 365 times per year. What's that? Well, that's $108, and we'll do some rounding. 33 cents. You know, if we really wanted to, we could compound every second. That would be 31,536,000 times a year. In this case, what would we get? Well, we would get $108 and 32871. By the way, that's a little more than what we got here. This was really 108.32867. So yeah, you could compound as often as you want. Notice, though, that even though these m's are getting pretty high, it's making less and less of a difference. So we can think about a mathematical construct, which is the limit as m goes to infinity. So m equals infinity. That's continuous compounding. It is physically impossible to compound something continuously. So we can think of m equals infinity as the mathematical limit of compounding more and more frequently. And you can see in the previous example that for all intents and purposes, you can reach that limit. It's not too hard. So we ask ourselves, what is the limit as m goes to infinity of our future value formula? 1 plus the stated annual interest rate, which holds constant, divided by m to the power m. What is this? Well, it has a name. We can calculate it. It is the exponential. We take whatever is here and we raise e to this power. E, by the way, is a number on your calculator. It's 2.718, and so on and so forth. So now, using this formula, we can calculate future value under continuous compounding. So let's just say that RA, we use this notation, is the stated annual interest rate. So if we want to calculate the future value of $100, compounded continuously for T years, we get 100 times e to the RA multiplied by T. Or we could calculate the present value of $100. That's $100 divided by e to the RAT, or e to the minus RAT. So it might interest you to know that this e, this exponential, was actually invented due to the continuous compounding problem. Leibniz created e to answer this very question of what happens when you compound continuously. So people sometimes think that calculus was invented to deal with physics, but actually that's not true. Finance is the much more fundamental subject. Okay, so now we have a potential problem because we have a bunch of different compounding frequencies. Let's just put them all on the same footing. And the way we're going to do that is we're going to define an effective annual interest rate. An effective annual interest rate is just what you'd think. It's the rate that, when compounded annually, produces the same return as the stated annual interest rate, compounded m times a year. So it's very simple. EAR solves 1 plus EAR equals 1 plus, remember R sub A is our SAIR, divided by m to the mth power. This is RA. So that's just the effective annual rate. So we can always solve for the effective annual rate. EAR is 1 plus RA over M to the M minus 1. So, for example, if RA is 6%, if M equals 2, the EAR is 1 plus 0.03 squared minus 1, or 6.09%. And if M equals 4, the EAR is 1 plus 0.015 to the fourth minus 1, or 6.14%. And if M equals infinity, the EAR is E to the 0.06 minus 1, which is equal to 6.18%. So let's do one more example, this one based on consumer credit. So credit card statements say something like the following. They'll tell you the period rate as 1.5% per month. Then they'll say something like APR, annual percentage rate, is 1.5% times 12 equals 18%. Now notice, this 18% is the interest rate you would pay if the credit card company charged you simple interest over the year. This corresponds to a stated annual interest rate. That's the concept that we defined before. And yes, you would pay 18% if you just were charged 1.5% per month and there was no compounding. But in reality, of course, the credit card company charges you interest on interest. So let's say you spend $100 and you never pay your bill for a year. So after 1 month, your statement reads $100 plus interest, or $101.50. After 2 months, your statement reads 101 times 1.015 squared. After so on and so forth, 12 months, your statement reads 100 times 1.015 to the power 12. Now that's not $118. That is $119.56. So really, your effective annual rate is equal to 1 plus the stated annual rate, or the APR, divided by 12 to the 12th power, or 19.56%. That's the interest rate you're actually being charged, and that's what the credit card company should report. Okay, so now we've talked about different ways of doing compounding and calculating present value. So now we're going to go on to actually value some securities.